Hey guys, it's Mike Barnes, the financial first responder. If you haven't done so already, please like and subscribe my channel and share this with someone that you love. Hey, look, today I'm going a little off topic, but I believe that it is topics like this that could change the way you do things moving forward financially. So, today, what we're going to talk about is the right way to use personal credit. Now, I know mama and daddy told you if you don't have the money, don't borrow it. At least I hope they did. But what happens is they don't teach you how credit really works. So for the next few minutes, I'm going to talk to you about ways that you can use your personal credit correctly, how to build, protect, and use your credit as leverage. That's what the financial first responder is going to talk to you about today. So without further ado, let's get started talking about personal credit. Mind you, I am a financial professional licensed, and this is for educational purposes only. So, why personal credit matters? Well, first of all, I don't know if you know this, but I'll tell you a little story that when I was in college, there used to be credit card companies that would come by and give you a credit card, and they never asked you how you planned on paying it back. They just gave you a credit card. And for a lot of college students back in the day, and they may still do this now, I have to check with my last two children who are in college to see if they're doing it still. But they didn't tell you that this stuff could impact you long after you left school. So it impacts your loans. It definitely impacts your insurance rates, your housing, as well as employment. There are people who cannot get employed for a government job or for having a security clearance because they've jacked up their credit. And so I want to talk to you about how this is so important, and that if mom and dad or aunt and uncle or grandma and granddad didn't talk to you about credit, hope is not lost. You can still learn whether you're 20, 30, 40, 50, hell, if you're even 60, you can still learn how to get your personal credit together. It determines the cost of interest that you're going to pay when you borrow this money. You know, unfortunately, some of you have gone down the road where if you go to a bank, they not only say no, they say hell no. And so unfortunately, it's based off of your personal financial habits. And so I want you to start using your personal credit correctly and understanding that if you understand the game, the credit game, you can be in a better situation. Um, this will also help you when you decide to start a business. How you use your business credit will be directly a reflection of how you use your personal credit. Now, in case you didn't know this, there are four data sources that business owners who provide credit for services or for products use. They use Equifax, Experian, TransUnion, and depending on your employer, they may even use LexisNexis to find out what type of person you are when it comes to your money. Now, of course, people are saying, well, wait a minute, I'm familiar with Equifax, TransUnion, and Experian. So first of all, in case you didn't know, every year you're allowed to get a free credit report. I want you to start tracking your payment history based off of using a journal. You could write it in a notebook, or you could use the financial positioning system, which we have here at True North Advisory, LLC. Um, you could also look at your current credit limits and your balances to see how well you're using your credit. And then you can look at your accounts, and then all of those nasty inquiries that you may not be aware of when you fill out stuff online. They either do a soft pull or hard pull. Soft pull doesn't affect your credit. Hard pull is an inquiry, and it lasts for a number of years on your credit. And then public records. You want to make sure that you've paid everything on time. Homeowners Association, any agreements that you have with companies, whether it be cars or whether it be personal loans, because all that is reflected, especially if it goes to court, in a public record. And TransUnion, Equifax, and Experian, and definitely LexisNexis will be able to tell you whether you've had some issues. Now, when we talk about credit score, obviously, the lower the score, the less likely someone is willing to lend you money. So, what is the LexisNexis? It tracks your identity and any risk data that you have currently. It's used by insurers and banks and employers to figure out whether you are a credit worthiness person. And then it affects your approvals beyond FICO. Okay. Now, I want you to think about this for a second. If you go to a job and you have a college degree, or maybe you have a trade, and let's say that you handle money for that business or that organization, if you can't handle your personal credit, why would they want you handling their money? Let that sink in for a second. Kind of deep, right? Of course it is. Well, what is a FICO score? It ranges from 300 to 850, and it's used by 90% of the lenders out there. It measures your credit risk. Now, I want you thinking about this for a second. If 300 to 630 is considered bad, I remember when banks would loan money at 620. They're not doing that anymore, guys. Let's just keep it real. Fair is from 630 to about 690, and then good is from 690 to 720, and 720 to 850 is great. That means you pay everything on time, and that means that you haven't had any lates. Now, let's look at how they judge you. Well, you're probably saying, well, wait a minute. How is FICO calculated? Well, first of all, they're going to look at your payment history. 35% of how you have paid your bills is how they judge you. 35% of your total score. Amount owed on your cards or your loans, 30%. Now, loans, they look at it a little differently, but if it's credit cards, if you owe more than 30% on any credit card, you could be considered a risk. Now, if you pay it off monthly, that's not a big problem. But if you let it sit there for long periods of time, that's where they get you. Credit length, 15%. How long you've had credit. You know, some of us have had credit, for, close to 30 years. And then some, you are just starting out. So how you build your credit is how you build your credit. You have a credit mix of 10%. So that's good credit, meaning loans, college loans, car loans. That could be your mortgage loans. That could actually be a personal loan, depending on what you did. And then new credit, that's 10%. So all of these take in account of how your FICO score is graded. Now, you're probably saying, well, wait a minute, Mike, financial first responder. You're the first person, as far as being in the financial industry, that I know or I've met, that I've gone through on YouTube or one of the other social platforms talking about credit, but you're a financial advisor. Why is that important to you? Because I know that if you apply for life insurance or health insurance or car insurance, they judge you based off of your credit. And you get higher rates based off of how good or how low your credit score is, I should say. So I want you thinking about that. This could affect, you being able to afford life insurance or car insurance, or even if you're a health insurance risk, because there's correlations. Let's put it this way. People who don't pay their debt tend to have poor health in some shape, form, or fashion. Now, we can get into the dynamics of that later if you want to have a debate about this, because you might be saying, well, I'm in the gym all the time. Yeah, but you don't pay your bills. So it doesn't matter. That's the way the credit system looks, right? So the right way to use credit, what we want to do is want to pay on time every time. I repeat, pay on time, every time. You want to keep your utilization under 30%. You want to use cards monthly, because just because you got a card and you never use it don't mean that you're actually using credit. So let's keep that in the back of our mind. If you're going to have credit, you got to use it, right? And then pay before your statement closes. Now, a lot of you probably don't know when your statements close. They actually tell you on your statements when your statements close. So I want you to think about, how do I keep and build good credit? Is I need to know the game, the credit game. So as far as smart credit habits, a lot of you, it would behoove you if you set up your accounts or your cards, your credit cards, on automatic payments. It would also help you if you decide later, as you build your credit history, to request credit limit increases. I want you to avoid unnecessary inquiries, meaning don't apply for everything. Be specific. If there's an American Express or a Visa or a MasterCard that you want, so be it. Discover card, so be it. An Apple card, so be it. Be strategic. If you order through Amazon and Amazon provides a card, maybe you have it. The department store cards used to be a big thing. Stay away from the department store cards. Use your major cards, ones that you will use for anything. If it's points that you're willing to get a card for, through one of the airlines or hotels, then do that. But be specific. And then monitor all your reports. Please monitor them, at least on a monthly basis. Look at what you're doing, because we know what gets measured gets done. There are some pros to having credit cards, and I don't want you to think that I'm anti-credit card, because that's not it. It gives you access to capital. Now, I want you to think about how I said that. Access to capital. It allows you to do some things when you may not have the funds readily available. It's emergency flexibility, i.e., we know that I talk about having an emergency fund, at least 3 to 6 times your expenses set aside. But what if it's something where you don't want to deplete your emergency fund for, but it's something that you have to do? Maybe it's to go visit a loved one who's dying. Maybe it's to basically help a loved one out that's in need, but you don't want to deplete your retirement account, more or less your emergency account, to help them. Maybe it's just to build trust with these lenders, because as you build trust, you build your credit. Maybe it's a foundation for you later having business credit. I just wanted you to think about, there are some pros to having a credit card, okay? But guess what? There are also some cons for using personal credit. Depending on your credit score, you could have higher interest rates. If you overuse your credit, it could damage your credit score temporarily or permanently, at least for 7 years. Any missed payments will compound on anything that would affect your credit. And then emotionally, spending risk. Some of you, as soon as you have a problem, your key is to get on the computer or go to the store and charge. I need you to think about what you're doing, because this could affect your credit limits. It could affect your credit long term. Some of you, I want you to understand that I want you to protect your credit. You can either have bad credit or you can have good credit. One of the ways that you can protect your credit is you can freeze your credit reports. In other words, if you freeze Experian, Equifax, or TransUnion, nobody can put inquiries on your credit report. They have to actually have permission to do it. If you freeze your LexisNexis, then nothing can be added to your LexisNexis report. I want you to find a monitoring service where you monitor your credit monthly. And then if you see a dispute, I need you to dispute it immediately. Immediately. Get it off your credit. That is the correct way to do it. Now, I'm not saying that you went out and charged something and then you didn't pay for it and now you're trying to dispute it. That's not what I'm saying. What I'm saying to you is there are ways that you can actually put yourself on track by monitoring and disputing erroneous things on your credit. My final takeaway is credit should be used as a tool, not as income. So money is a tool, right? We've established that money is a tool and you have to make money work for you. So you have to have good money habits and you have to be mindful of what you're spending. You need to use intentionality whenever you're using your card. Hey, I know I'm using my card. When can I pay this back? And then you need to protect yourself from people that might have access to your card by watching out for phishing or different scams on the internet where they want you to put your card in. I need you to understand that this is a way that you can take back a part of your financial legacy or your wealth strategy, build your wealth strategy. Now, if you like the information that I've given you today, I want you to come to my website, truenorthadvisoryllc.com, book an appointment with me. Let's see how we can help you on your road to wealth. Look, this is Mike Barnes, the Financial First Responder. Please like and subscribe my channel. I look forward to helping you, and I just want to thank you for taking the time to listen to me talk. Share this with somebody you think it could be beneficial to. Train your children in a way that they won't depart so that they won't make the mistakes that others have made, including you, in the past. Till we talk again, God bless.